Option spreads are created by going long and short similar options. So you can create option spreads by going long and short call options, or by going long and short put options. The difference between the two options that you've gone long and short is that they have different strike prices. Okay? Now, if they've got different strike prices, one of them must be low and one of them must be high. And the idea behind these spreads is that you have exposure between the strikes, but not outside of the strikes. So these spreads give you a moderate amount of exposure to the underlying asset. They can be bullish. In other words, they can give you moderate upside as the underlying rises, but it's capped upside, it's also capped downside as well. If I were to picture what a bull spread looks like, which is always useful, if you've got a low strike here, one of your options, and a high strike here, remember what I said, you've got exposure between the strikes, so the net payoff will be going up between the strikes, but outside of the strikes, you haven't got any exposure. So that's a bull spread. You profit if the underlying increases in price between the strikes, all right, but you don't profit if it goes above the high strike. It's less bullish than just buying call options because it's got moderate downside and moderate upside. A bear spread looks very, very similar, but it's moderately bearish. It profits if there's a decrease in price between the two strikes that are being used. So to construct the analogous kind of picture here, a bear spread is moderately bearish. There'll be a low strike, there'll be a high strike, and when you look at your bear spread net payoff, it will look like this. It will win as the underlying falls. Don't forget, the horizontal axis here is always the underlying. Okay, we've been doing this through several modules here, but the horizontal axis is always the underlying. And you can see under this bear spread, as the underlying falls, we win. But it's moderate exposure, isn't it? It's only between the two strikes, and there's no further upside when you go below the low strike. There's no further downside when you go above the high strike. So it's bearish, but it's not as bearish as just buying straight out puts. So the crucial question here, now you know what these basic spreads are, the crucial question is how do we construct them? Well, we only need to remember really one thing when we're constructing either a bull or a bear spread. You can do it with using calls, or you can do it using puts. But the key rule that you need to remember when you're constructing your spreads is contained in those two L's there. If you want to create a bull spread, whether it's with calls or whether it's with puts, you go long the low strike option. Okay, and you know the implication is that you would sell the high strike option. So this is a key way of remembering how you construct these strategies. If it's a bull spread, the double L of bull reminds you that you go long the low strike. There's a double L there. It's double L of long the low. Double L of bull reminds you that you go long the low strike. Okay, therefore you must sell the high strike. And really, that's all you need to know to construct a bull spread. If you're using calls and it's a bull spread, what do? You go long the low because it's a bull spread. If you're using puts and it's a bull spread, what do? You go long the low because it's a bull spread. Long the low strike, sell the high strike. Okay, so it applies to either calls or puts. To create a bull spread, go long the low. And then, you know, you don't need to really remember what a bear spread is because you can think of the opposite of a bull spread because it is the opposite of a bull spread. You can think if bull is long the low, then bear is not long the low. It must be short the low, strike option, and buy the high strike option. So let's have a look at a bull spread in action. Remember that way of remembering it. Bull means we are going long the low strike option. Okay. So when you're given the two options, one of them will have a low strike, one of them will have a high strike, and you just need to identify which one is which. You can see this investor here, they're doing it for you here, but this investor buys June 50 calls for 740, That's the day they buy it, but that's the expiry. They also sell higher strike calls. 55 is higher than 50. So yes, this is a bull spread because they're going long the low strike option, long the 50 calls, that's $7.40. They're selling the 55, that's the high strike option, similar option, call for $5.20. Now this is a debit spread because buying low strike calls is going to be expensive. Buying low strike calls is going to be expensive. So this is going to be a net outlay. That's what they mean by debit spread. There's going to be a positive cost to this strategy. You're going to have to pay for it. In fact, what you could do, and one of the most important things that you do with these spreads is to calculate what that net outlay is at the start. Okay, simply, you're paying $7.40 for the low strike call, and you're bringing in $5.20 for the high strike call. So rather trivially, your net outlay here is $2.20. Now the trick with both these bull and bear spreads is as follows. If you've got a debit spread, in other words, if you're paying to enter the spread, which you should be able to tell through the analysis that we're already aware of. Bull is long the low, okay, bear is short the low, and then you can see from the option prices whether you are paying with a positive cost to enter the strategy or whether you are being paid, what's called a credit spread, to enter the strategy. But here's the basic idea. If you have a net outlay at the start, in other words a debit spread, that's the worst that can happen. Just like when you buy an option, the maximum loss is the premium that you pay. When you enter into a debit spread position, if you're paying to enter it, which you will do for a debit spread, then that's the worst that can happen. So that's actually your maximum loss. Can't lose any more than what you're paying out at the start. Okay, and when you think about your overall P&L, what you can do with a bull spread, when you think about your overall P&L, is you can say, we know that a bull spread looks like this. There's a low strike, in this case it's $50, and there's a high strike, in this case that's $55. And you know that your bull spread, in general, looks like this. It's moderately bullish between the strikes. Okay? We've deduced that when you sum up your net premiums, all right, you get a positive cost. Here, in this particular example, you get a positive cost of $2.20, and you can't lose any more than that. All right, that's a rule. Take that away. If it's an outlay, a positive cost, that's an outlay. You can't lose any more than that. That's the maximum loss. That must be where you are here. You must be losing $2.20 there. Okay? Now, you'll have seen me do this a few times over the modules in this particular section, and that is, once I've got a point in the overall payoff, I look for triangles, because I know that any diagonal line here is a 45-degree line, and therefore this distance here, which I already know to be 220, that's my maximum loss, that must be the same as, well, there's a triangle right there, must be the same as this distance here, 220. Okay, it's that golden triangle rule that we've been using a lot. Horizontal distances are the same as vertical distances, and obviously vice versa, because all of these triangles are right-angled 45-degree triangles. So that gives me my break-even. My break-even here, where I cut the x-axis, is 50, the low strike, plus my net premium, which is 220. So obviously that's 52.20. That's my break-even. And of course, it doesn't take too long to see another triangle here where we can get our maximum gain. The other triangle that we can see here is from this point, 52.20 to 55, there's a triangle there. Now this distance here is 55 minus 52.20, which is 280, right? There's 220 here, 280 there, and that accounts for the 5 that is the difference between the strikes. So if this distance is 280, then this distance must be 280, and that, therefore, is your maximum gain. So that's how I would advocate approaching these spreads. This was a debit spread. How did I know that? I knew it because there was an initial outlay. I knew it because I had to pay money to enter into this option strategy. Now, being an options position, that's as bad as it gets when you pay for options. All right, you can think with the strategies that we've got in front of us, if you pay out for a spread, that's as bad as it gets you at the bottom of the ramp, so to speak, because there's a ramp, isn't there, between the two strikes. And if you start off at the bottom of the ramp with that maximum loss, then you can use your triangles to get you home quite quickly. And that's how I would advocate dealing with these strategies. All you really need to know is bull is long the low strike, whether it's calls or puts, bull is long the low strike. And then if you look at your premiums, if you're paying to enter the strategy, that's your maximum loss. We'll have a look at in a moment in a situation where you get paid to enter a strategy. As you might imagine, that will be your maximum gain if you get paid to enter a strategy, just like when you sell options and you generate premiums, that is your maximum gain. But let's have a look at another strategy. Let's apply this technique again. And the more we apply it, the more useful, I think the more familiar you might get with it. I mean, the slides here are agreeing that our net outlay is 220. All right, the maximum upside is when we're at the upper strike, because any further rises in the underlying above that are lost, given away by the short call. Maximum profit, they agree with us, is 280. I think really there they say, well, you know, you'll win when we go between the strikes. You could think of it like this if you want. You know, we win the $5 that we make as we go between 50 and 55, but we take off what we paid for the strategy, and that leaves us with just 280. That's another way of thinking about it, or you can see it like that. The maximum loss is the premium paid. In other words, sum of premiums, it's a debit spread. It can't get any worse than that. When you net buy options, your first outflow is the maximum loss because you could just throw your options away. All right, with these spreads anyway, it works that way. Break even is 220 above the lower strike. They're kind of using my triangle rule there. 220 above the lower strike, you're making back that loss when you go 220 above the lower strike. All of that is captured by that little diagram there. Let's have a look at another type of spread, see how we get on. So let's have a look at a bear put spread. Now remember, what do we need to know about bull and bear? Bull is long the low strike. Well, this is not a bull spread, this is a bear spread. So it's not long the low, it is long the high strike. High strike option here is the 55, and you can see the investor buying those puts. If we're going long the high strike, we must be going short or selling the low strike, and that's exactly what's going on here. Now, if we're buying high strike puts, you know, the right to sell high is going to be more expensive than the right to sell low. So we're going to get a net outlay again here. This is another debit spread. The net outlay here is $6.61. You're paying for the high strike put minus $3.87 that you're receiving in for the low strike put. You'll see how just calculating that net outlay, that net debit, is a very important part of the process. That is an outflow, that is a cost, a positive cost. That is actually your maximum loss. That's as bad as it gets. Okay, you can't be asked for any more than that. So you know generally what this bear spread's going to look like. If we were to sketch it out, a bear spread generally would look like, there's your low strike of 50, there's your high strike of 55. A bear spread generally looks like this. It's moderately bearish. That's what a bear spread looks like. So what you've just calculated through your net premiums, calculating your net premiums, that's an outflow. This is a debit spread, that's an outflow. You've just calculated your maximum loss right there. Doesn't get any worse than that. $2.74, you've just calculated that maximum loss right there. $2.74. So what you can do now, without any more further thought, you can just look for triangles. If this is $2.74, this horizontal distance must be $2.74. So now you have the break even relatively quickly. The break even must be 55 minus $2.74, which is 52.26. And once again, the triangles are getting us home here quite quickly, because if this distance is 226, which it is, yeah, don't forget the break-even is 52.26. Distance between, therefore, 50 and 52.26 is 226. Well, that's this horizontal distance. It must be that vertical distance as well. So that is your maximum gain. You know, crucial to all of this, with this bear put spread, was that you calculated your net premiums and it was an outflow. So you were at the bottom of the ramp. That's the point I'm going to reinforce here, is that this was the sum of the premiums. All right, and it was a positive cost, which means it was an outflow, a debit spread. It can't get any worse than that outflow. Just like when you buy an option on its own, can't get any worse than what you pay for it at the start. It's the same with these spreads. Okay, so we'll see that the slides here are going to be agreeing with our diagrammatical analysis. Net outlay of 274, that's the sum of the premiums again. Maximum value is when the stock closes at 50. Yep, that's when we get the most upside, that's for sure. Further upside to the long put is hedged away by the fact that we've shorted a put at the lower strike, which starts losing money at that stage. Maximum profit, 226, we agreed with that. You could very well say, well, you get the $5 from going between the strikes, because that's the difference between the two strikes, but you also have to pay the net premium. So you could just quickly get there. That is for a, that is the same as what we were saying for a bull call spread earlier. The maximum loss net premium paid doesn't get any worse than that, $2.74, and the break even must therefore be $2.74 below the high strike, because that's where we've made $2.74 back, essentially from our net exercise decision that pays for the net premium. Okay, the two spreads that we've looked at so far have been debit spreads, and what I mean by that, they have both been net initial outlays. Now there are two other types of spreads, okay, they will be net credits. So for example, a bear call spread. All right, so bear is not long the low like bull is. Bull is long the low, bear is not long the low. Bear is going to be sell the low strike option, buy the high strike. And if you think about it, this one you're going to get paid to do. This is going to be a net inflow, a credit spread. Why? Because you're selling attractive low strike calls and you're buying cheap high strike calls. So this one you're going to be paid to do. The difference is, well, you know what a bear call spread is going to look like. You know what a bear spread is going to look like. Okay, if you've got two strikes, let's call it just generally XL and XH, you know what a bear spread is going to look like. It's going to look like this. It's moderately bearish. Still a bear spread, you've just created it in a slightly different way. But here's the thing that's different here. With a bear call spread, when you're selling expensive low strike calls and buying cheap high strike calls, you're going to find that you're going to be paid to do it. Now this inflow is actually as good as it gets. Instead of the outflow for a debit spread being your maximum loss, here we've got an inflow being the maximum gain. So what you would do here, exactly the same analysis as before, sum up your net premiums, but that puts you at the top of the ramp, puts you there, all right? The net premiums for a credit spread, all right? You'll find the net premiums are a negative cost, which is an inflow, and that inflow is as good as it gets. That's your maximum gain. So you can use exactly the type of analysis that we've been using to get that point in the map, the top of the ramp. Credit spread, top of the ramp. And what that means, given that you know your maximum gain, I'll just generalize here, you know what that distance is. So you know that distance, which can get you your break even, and then you can use that triangle to get your maximum loss. Okay? So rather than learning esoteric formulae here, that all look similar and are rather unhelpful from a memorization perspective, why don't we try and draw? Let's have a look quickly at a bear call spread. Try and draw it and see what happens. There's a 20 strike call, and that's trading at, let's say that's trading at 2. And then there's a lower strike call, which is going to be more expensive because we like buying lower. Let's say that's trading at 6. So with a bear spread, right, bear is not bull. Bull is long the low, but it's not that. It must be long the high strike. So we're going to go long the high strike option, and we're going to sell the low strike option. So now you can see that your net premium that you need to pay is 2 to buy that long, but minus 6 when you sell the more expensive option. So that's minus 4. So your net premium is a negative cost. Now, if something's got a negative cost, that means it's generating an inflow. And that makes it your maximum gain. Top of the ramp. You know what a bear spread looks like. In this particular case, our strikes are 15 and 20. And you know that your bear spread is going to look like this. It's moderately bearish. As the underline goes down, we win. But you are being paid. This is a credit spread. You're being paid to enter this spread. You're being paid for to enter this spread, and that is as good as it gets. In other words, that's you at the top of the ramp. That distance there is 4, and that's your maximum gain. That makes this distance 4, okay, because of the triangle rule. That distance is 4, which makes this break even is 15 plus 4, which is 19. I haven't drawn it, perfectly by any stretch of the imagination here, but I just need to sketch out, if we've gone 15, if break even is 19, we only need to go a further 1 to get to 20. So actually the downside here is 1. All right, so that's your maximum loss using the triangle rule on the right hand side. So you can see I'm using exactly the same strategy as before for the debit spreads. The only difference is for the credit spreads, we are starting at the top of the ramp. We've got a negative cost, an inflow, that's our maximum gain, and we are starting at the top of the ramp. So yes, if you understand that geometry, maximum profit is the net premium inflow. Yep, that's great. The break even is the lower strike plus the net premium received, because that's when you get dragged down to break even. Okay, that's when you lose the premium that you've brought in. And the maximum loss, well, it's the difference between the two strikes. Okay, that's your maximum losses. If the underline goes up through both strikes, you would lose the difference between them, but you can take off the net premium that you receive in. That's going to lower your maximum loss. The final type of spread is a bull put spread. So a bull put spread, we can use our rule. Bull is long the low strike option. So it's long the low strike, sell the high strike. Okay, bull is long the low, and that's whether it's puts or calls. Now when you go long low strike puts, which aren't very attractive, and you sell high strike puts, which are quite exciting, because selling things high is exciting, what you find is you're going to be generating, you've guessed it, money coming in. So look, without overcooking this, the general idea here is you know what a bull spread looks like. When you add up the net premiums, you're going to be here at the top of the ramp. Okay, there's your low strike, there's your high strike. When you add up the net premiums, that's as good as it gets. When you get paid to enter a spread, that's as good as it gets. Just like when you get paid to sell an option in general, you get paid the premium and that's as good as it gets. And then you can use your triangles to get you whatever you need to know. All right, that would be your net premium there, the net premium inflow. And then you've got this distance and this distance, as we've done 3 or 4 times now. Okay. Turns out here the maximum profit, yes, is the net premium received. That's exactly what this graphic is trying to say. The break even, therefore, will be how far the net premium is below that high strike, because once you move that far to the left, you've given up that net premium, essentially, in terms of losses, and you break even. And the maximum loss is the difference between the two strikes, this total distance here, minus the net premium that you are receiving in. So there is a summary slide at the end here, the general formulae for the exam. For debit spreads, like bull call, long low strike calls is expensive. Bear put would, a bear spread is not long the low, it's long the high strike option. So long high strike puts is going to be expensive there. Maximum loss is the net premium, that's as bad as it gets. Maximum profit, difference between the strikes minus that net premium, because you gain the difference between the strikes, but you're still paying away that net premium. For credit spreads, that's bear call and bull put. Maximum loss is the difference between the strikes minus the net premium. That becomes your maximum loss here. Maximum profit is the net premium, that inflow, and then of course your maximum loss is the difference between the strikes minus that inflow. For call spreads, the break-even is the lower strike plus the net premium, and for put spreads, the break-even is the higher strike minus the net premium. Now, if I were in your shoes, I would probably be sitting there thinking, well, crikey, am I going to have to remember all of these formulae? And the answer is not if you've understood how each one of these basic payoffs was generated. And the simple rules were as follows. Bull means long the low. Now you know that you can apply that to both calls and puts, all right? And you can generate the spread from that. Bear must be not long the low, but short the low. Then you sketch out your basic diagram. If it's a debit spread, that's your maximum loss. So go back to this one. If it's a debit spread, that's your maximum loss. Then you can use triangles. You can see what break-even and maximum gain is. If it's a credit spread, all right, that's your maximum gain, like this one here. Okay, it's your maximum gain, and you can use, once again, you can use triangles to get your break-even and your maximum loss.